Hello, everybody, and welcome. We're going to be talking about a particular liquidity risk measure that I suggested banks might want to consider, or certain banks might want to consider, in light of what we observed happening with the bank runs, the liquidity runs on two banks in the US, Silicon Valley Bank and First Republic Bank, both of which subsequently failed. And I'm sure you're all aware of that. Now, I posted this slide deck 4 or 5 weeks ago, and got a lot of comment and questions on it. So I thought this video might help as a follow-up to that. In essence, I wanted to start off by saying this is merely a suggestion. It's not a regulatory requirement. One is not obliged to follow it or adopt it. And if one feels that within a bank that all your liquidity risk metrics are already the full picture and you don't need anything else, well, then you can ignore the rest of this video. But really, I thought of this in response to what happened with the bank runs, what we observed with the bank runs with these two failed US institutions, and also in consultation with other market contacts who were considering this. And I emphasize that certain banks have a less diversified funding structure, a more concentrated funding structure than others. And in the social media age, perhaps they might be interested in adopting this metric. And the key to this presentation is social media. What we observed was a good old-fashioned bank run that resulted after a loss of confidence in these two institutions. But the key difference was the outflow of funds was much quicker than what we've observed in the past. So I want to emphasize that the type of risk we're talking about now, liquidity risk management, is as old as banking. It's something that banks have had to manage as part of their ordinary course of business, their business operations, ever since modern banking came about. And managing liquidity risk, as I said, is a traditional discipline within banking. But there is something that is different in 2023 compared to what we've observed with earlier bank runs, insofar as social media, together with an ability to access one's deposit account at a bank via a smartphone app, those two combined means that if there is a loss of confidence, the outflow of funds is very quick, well, certainly compared to what we've observed in previous bank run scenarios. Hence the response with this short-term liquid cash ratio. Now, quite handily, liquid cash ratio, the acronym liquid cash ratio, is identical to the regulatory LCR. That's quite handy, isn't it? So the Basel III introduced metric from 2010 from the Basel rules finalized in 2013 referred to a liquidity coverage ratio, or LCR. I'm suggesting some form of liquid cash ratio as an additional metric that a bank may wish to consider. Now, first of all, what was the LCR, or what is the LCR? Well, it's a universal international liquidity risk metric. So any bank that is within a jurisdiction that has implemented Basel III guidance, and that's most countries in the world. I always like to ask as a kind of pop quiz question or a pub quiz question whenever I'm teaching, can you name any countries that haven't adopted Basel III guidance? And as far as I'm aware, it's only a handful. So that means most banks in the world will be obliged to calculate and report and put limits against and manage to these limits this metric, this short-term liquidity risk metric called the liquidity coverage ratio. And it's calculated in the way that's just shown there on the slide. Stock of high-quality liquid assets, an actual number that one can observe, divided by an assumed outflow, an assumptions-based outflow. And this metric, this ratio has to be greater than 100% at all times. That's Basel guidance, which most countries in the world have adopted. Now, in the UK, actually, the UK regulator refers to LCR as Pillar 1 liquidity risk, analogous with capital, where you have Pillar 1 capital and then you have Pillar 2 capital, which is additional capital to address capital risks that aren't covered by Pillar 1. So in the same way, the UK PRA has introduced something called Pillar 2 liquidity risk. The idea being Pillar 1 liquidity, LCR, doesn't cover all a bank's liquidity risk types. So we have some additional liquidity reserve requirements given by Pillar 2. Now just park that thought at the back of your mind for a second while we get back to the subject at hand, which is social media risk and what we observed with these two failed banks in the US. Before we do, I want to highlight the denominator of that LCR, which makes them assumed outflow or runoff factors in an assumed stress event. So it makes an assumption that in a 30-day period, LCR is a 30-day metric. I omitted to mention that just now. It's a 30-day metric. If we assume any kind of stress event that is resulting in a liquidity outflow, there are various outflow numbers to put depending on the type of product and the type of customer that is deposited with the bank. So if you look down there, the factors or the outflow numbers or the assumed runoff factors range from say 3 to 10% for retail customer and small corporate customer deposits, all the way up to 100% for financial bank or non-bank FI type customers. And these outflow numbers are part of the regulatory guidance, the Basel guidance. So there's two things there. There's an assumed outflow number, and this outflow is assumed to take place over 30 days. Okay, and there's an example of a calculation. We have a calculation here as a UK commercial bank. We've seen it's got different types of outflows depending on the type of deposit here on the left-hand side, and then the encircled number shows the outflow number for a particular type of customer, which is professional instant access, professional customers. So, and then the type A refers to what the UK regulator referred to as unstable deposits. So, depending on how your funding structure is set up, if you have more or less type of stable or unstable funding, your outflow number, the denominator of the LCR, will be greater or smaller. Now, let's also bear that in mind, because the two banks in question here, the failed banks in the US, had an excess concentration in a particular type of deposit customer. These are what one might call non-bank FI customers. Corporate depositors would be financial institutions, fintech firms, venture capitalist firms, possibly crypto exchanges, that sort of thing. Non-bank FI customers. And as we saw there, as we can see there with the slide, this is what the UK regulator used to call type A unstable deposits. Hence, there's a 100% outflow. But 100% outflow in 30 days. What if that outflow occurs much quicker than 30 days? Is it worth having some metric to address this particular exposure? Now, I emphasize, if you had concentration amongst a particular type of customer, and they were what were deemed by the regulators to be 100% outflow depositors, then that is a particular risk exposure that, again, we would refer to in the UK as Pillar 2. It's not covered by LCR. There's insofar as it's the concentration risk associated with having lots of customers or a majority of customers of a certain type may mean that the LCR metric doesn't capture that risk, and that's what Pillar 2 risk refers to. Let's move on to the next slide here then. So an LCR, but in the way I've named that acronym, LCR, liquid cash ratio. Let's consider a takeaway, a learning point for based on what we observed earlier this year with the two failed US banks. So, for example, Silicon Valley Bank suffered a 35 billion outflow in under 48 hours. Negative social media commentary spread like proverbial wildfire and hastened the elimination of confidence in the bank. Now, that is a very large outflow by any standards, but it's not just the size that is a notable factor here, it's the speed of it. So we've got negative news about an institution being spread very quickly through social media, but we've also got an ability to access one's deposits via instant access via the smartphone or online, and those two combine to produce a very large size outflow in a very short space of time. Now, the Pillar 1 liquidity metric that is given by liquidity coverage ratio, LCR, doesn't capture this risk. So it's not a new type of risk, it's still liquidity risk, but there's a new factor here which we can call, or I've chosen to call, social media risk. And here is my suggestion for this. Again, it doesn't necessarily apply to every bank. My suggestion is a 3 or a 7 day metric, a short-term metric, whether it's 2, 3, 5, 7, 10, anything between 1 and 30, that's your call really, but a short-term metric, let's call it a 3 day or a 7 day LCR, but LCR standing for liquid cash ratio, or a liquid cash amount. In other words, we make an assumed outflow. We still assume a firm-specific stress event that results in high amounts of outflow, and we want to make sure that our liquid cash provision is greater than that assumed number, hence liquid cash ratio. Any resemblance to the Basel LCR is purely coincidental. But do I really mean that? I like the fact that it uses the same acronym, but after that we can part company. So a liquid cash ratio, which basically measures what liquid cash provision reserves you have against the worst case firm-specific stressed outflow, which also, I have to admit, is an assumed number. Okay, so if our liquid cash provision is greater than this assumed worst case scenario, say a 3 or a 7 day outflow, then we have a green tick. We have the green light on the red, amber, green status. If not, it's something for us to consider further. Now, a picture is worth 1,000, well, not necessarily maybe 1,000, but a picture is worth a number of metrics, and it might be better simply to report this as a bar chart. So we make an assumption of the worst case scenario, whether it's 2 days, 3 days, 5 days, 7 days, 30 days, what have you. We have a liquid cash ratio, which is the liquid cash amount, and the outflow number. The assumptions behind this outflow number are key, and provided the blue bar is greater than the red bar, we're within our own appetite. If it's below that, then we have something that we need to consider. Hence the liquid cash ratio. That's pretty much it. It's a very simple, straightforward metric. It's not particularly complex. It's not pretending to be anything other than it is, simply showing how much surplus liquid cash one has in place at the bank. The key difference between my LCR and the Basel LCR is that the numerator is pure liquid cash. It's cash at the central bank. If you wish, cash held in Nostro accounts at another clearing bank. Now, that's not actually eligible for HQLA under the Basel metric, but this is an internal metric. It's not an obligation. It's not obliged. We're not obliged to report it. It's not a regulatory requirement. It's an internal metric for your own risk management purposes. If you wish to include cash held at the Nostro accounts of other banks, then that's your call. I do think that cash held at a GSIFI bank may be counted as liquid cash, because if you're unable to obtain your cash from there, then we really are in some serious trouble. But that's a discussion for your ALCO. So there we go. This addresses the concentration risk that is not addressed by LCR, but more importantly, it's a response to the high speed of transmission, the high speed of transmission that we may be subject to if they're in a negative situation, a negative stress, a firm-specific stress scenario that requires us to have a surplus amount of cash to meet that immediate outflow, let's say the first 3-day or 7-day outflow. This metric is not a panacea, and it's not an alternative to sound overall asset liability management discipline. It's not a metric that is meant to cover all your ALM risks. Okay, it's a response to what I've called social media risk. Social media risk isn't something that only affects liquidity. Here's a little extract that I saw on risk.net a couple of months ago. Social media risk will impact your reputation. It could even be fake news. What if there is news about the bank that isn't actually true, but it's being spread very quickly through social media, and if enough people believe it, there could be an outflow at the bank. So there's a quote that I quite liked there, nip it in the bud. There's a quote down there from risk.net. Any bank that doesn't pay attention to their social media presence and the effect it might have on deposit behavior is doing themselves, their stakeholders, and most importantly, their depositors a pretty significant disservice. That's basically a long-winded way of saying, you need to address social media presence and address negative news about your institution very quickly. Now, this takes social media risk beyond the narrow liquidity risk focus that I've had on it up to now. So we're not ignoring that. But of course, if there is a firm-specific stress event, the speed of transmission, the speed of transmission and the speed of outflow is going to be much greater than we've seen in the past, hence the requirement for a liquid cash ratio. Now, when I presented the slides without the video on LinkedIn last month, or 5-6 weeks ago, there was some really all commenters always welcome. All commenters welcome, whether you agree with me or not. There were some comments on there that I thought I might just pull up and just clarify here on this video. First of all, as I emphasise, it's an internal metric. It's entirely up to the institution whether it wants to adopt it. A critical question is how much of an outflow should we look to cover in a business as usual scenario. Obviously, a bank isn't going to hold liquidity reserves for a 90% outflow. They would never be able to do any business. That's an unviable business model. Banking is all about running liquidity risk. It's part of what maturity transformation represents. So how much outflow would a bank wish to cover? Well, we know it's not 80, 90, 100%, but at the same time, it's probably more than 2, 3, 5, and 10%. So that sweet spot might be between 10 and 20%. If between 10 and 20% of your balance sheet is in HQLA or liquid cash, that's similar to the business model that one would have observed in banks pre-2000 and in the pre-21st century. So anything between 10 and 30% seems like the right range. But again, it's your call. It's the bank's own risk appetite that is being addressed here. How much time should we allow to get a handle on loss of confidence? Again, because of social media risk, as I've termed it or as I've defined it, we should expect that any negative news impact plays out very quickly. You would have noticed that the two banks that failed, as well as Silicon Valley Bank's UK arm, there was no recovery period. There was a loss of confidence and there was immediate resolution. So we need to address a very short-term loss of confidence and what we're going to do about that. Finally, someone has commented that a bank that has a good early warning indicators in place should be able to see this sort of thing coming. Perhaps not. If you feel in your bank that you have a suite of early warning indicators that will enable you to observe an oncoming or an emerging social media impact on your liquidity position, then of course you don't need this metric. If on the other hand you think that sometimes, despite all the best will in the world, early warning indicators don't always give us early warning, then it's probably a metric that you might want to consider. I personally think it's a really good idea, but then I would say that, wouldn't I? Okay, thanks very much for your attention. Slightly longer video than normal, I have to admit. The references for ALM and liquidity risk are there in front of you. I welcome all comment on this video or on any of the content of those references. So if you have any, do please post away, and I will respond to them. Thanks for your company. Thanks for listening, and have a good day. Bye bye.